All right, we're going to go ahead and get started. My name is David Bragg. I'm a director here with Camco Management. Welcome. Today for you, we have the CAI, or Community Association Insurance Challenges. How to improve insurability and contain cost. This is going to be presented by Evan Dash, who's a senior vice president for risk strategies. Um, a great company to provide you with all your insurance needs. And we'll go ahead and get started here. Go ahead, Evan.
Well, thanks, Dave.
Turn
Before I
over to
get
you.
going, can everyone can hear me good? Perfect. All right. So as we jump in, I want to emphasize, at least from my end, that I find that these presentations usually succeed and go best when they're discussions, right? I'm not here to lecture you. Well, I guess I am, but I don't want it to be a lecture. So I try to make these as interactive as possible. Please interrupt me, ask questions, raise your hand. I think, as I said, once we have a conversation, and we can kind of break down the walls of what might be, questions, concerns. If you're thinking it, someone else is likely thinking it as well. So please do not hesitate to jump in and ask any questions. So, having said that, all of us in some capacity are in this world, and no one is immune to the insurance challenges that have been impacting residential associations. The premiums have been rising precipitously, and we'll get into the reasons why. But I think that part of the frustration isn't so much with the rising costs. Sometimes costs rise not only in insurance, but in other vendor services writ large, but more about the lack of a plan and the lack of any ability on most brokers' part to provide some sort of comprehensive strategy for these associations on how to navigate this market, right? As I said, everyone knows what's happening, right? The premiums are going up. No one's immune from it. But the main question that we've bumped into and the success we've had is, okay, in spite of all of this, A, why is it happening? B, once we understand why it's happening, what can we do to navigate around it? What do these underwriters want to see? What can we as associations implement, engage in, kind of proactively do so that we are able to position ourselves for success within the context of a challenging and ever-changing market. So having said that, I alluded to this earlier, but why are insurance costs rising is really important to understand, because once you understand the reasons that they're rising, you can kind of weave a strategy throughout that. So they're rising primarily for two reasons: on the property and the general liability side. On the general liability side, they're rising because of increased claim frequency and increased claim severity. So if you think of it as a dichotomy, what do claims happen frequently, and when they happen, are they severe? A short drive, unfortunately, up or down 95, you'll see all of the personal injury attorneys, you'll see all the billboards, you'll see everything. People are incentivized to bring these lawsuits against associations, against landlords, against any type of person like that. And when these lawsuits actually get to adjudication in the ultimate jurisdictions, they're settling for more than they did previously, right? It's a phenomenon called social inflation, which I have outlined there. And it essentially means that when claims happen, when claims get in front of a jury, juries, for whatever reason, are siding with the plaintiffs against the defendants, meaning they're awarding these plaintiffs increased decisions, increased values, increased sums that they wouldn't have previously. That has two effects. A, it incentivizes these insurance companies to settle these claims before they ultimately get to adjudication, which only then incentivizes people to sue them more. And B, if they do get to adjudication, claims that carriers were used to paying, let's say $10,000, $30,000, $50,000 are now $100,000, $300,000, and $500,000 respectively. Those have put a crunch on these insurance companies' bottom lines, which is leading to increased rates. The second thing is catastrophic property losses, which is kind of tied to the rising construction and repair costs below. Everything, again, no surprise to you, costs more. Supply chains from COVID are still a little wonky. Importing goods with tariffs have led to increased costs. Labor costs are up. So when there is a loss, actually remediating that loss and fixing that loss is costing insurance companies more than it used to. So a claim, that some water damage came in from the window, it affected a couple of key components, maybe used to get remediated for $30,000. Again, that's now up to, let's say, $70,000 or $80,000. So it's all just putting an increased financial crunch on the insurance company's bottom line that's translating down to you as the customer and these associations. So in addition to that, there's kind of a macro economic factor here with regards to limited carrier capacity. The way that previously it worked when interest rates were a little bit lower is when insurance companies restricted their capacity, new insurance companies, new entrants would borrow capital and come into the market to fill the gap that these insurance companies that can no longer write it left. And they would do so at cheaper premiums than the old people were charging. So given the increased costs of borrowing, that's more happening at the macro level. No one's coming in to fill the gap. So the insurance company, because it's just too expensive, it doesn't make any financial sense. So the insurance companies that are in this space don't really have any competition. So they've restricted their capacity. They're raising their rates. There's no other new entrants into the marketplace. And that, again, kind of leads to a trickle-down effect of increased premiums and increased rates across the board. So having said that, all of that good news, what can we do about it? Right? We as associations, we as property managers, we as board members, once we kind of acknowledge and understand what's happening from a larger macroeconomic context, what strategies can we plan? What steps can we take to navigate this changing marketplace? And before I kind of get into that, does anyone have any questions? All right. So the main thing that we've realized here, and this is kind of the bread and butter of how we operate, is we want condominium associations, homeowners associations, planned communities, whatever it might be, any type of residential association, to become a best-in-class risk. Becoming a best-in-class risk serves a myriad of different purposes on the front end and on the back end. It allows us as brokers to tell a story to the underwriters to position you to receive that limited capacity and the best rates they have within their limited capacity by positioning you as best in class. When we become best in class and when we take the steps necessary to get to that point, we're proactively shifting and engaging as boards in a way that reduces claims on the front end and makes us more insurable over the long term. So that is ultimately what we've found as the best strategy to navigate this marketplace, to proactively engage internally in the mechanisms, in the activities, in the processes, in the procedures, in the codifying governing documents, and everything like that to mitigate risk front end, working risk down over the long term, while at the same time engaging the carriers to receive their best rates. Now, I'm going to tell you what it means or how we've achieved this qualification of best in class. But again, before I do so, any questions here? Any questions from anyone? Okay. So what does it mean to become best in class, right? As I alluded to earlier, that is what we strive for as a broker of residential associations. If we can position these associations to become and be viewed as best-in-class risks, we have found that we're able to get the best rates of the limited capacity from the insurance companies. So what does that mean? How do we get to that point? How do we cross that bridge? And how do we become best in class? The word to associate with all of these things that the underwriters want to see is proactivity. We want to proactively engage in preventative maintenance. We want to proactively require that the unit owners and the boards themselves take the necessary steps to proactively mitigate risks by proactively requiring updates, by proactively requiring replacements, by proactively maintaining the association. Similarly, with regard to association responsibility, we want to engage the governing documents, and we'll get to this later in the presentation, but we want to engage the governing documents and use those governing documents as a tool to shift risk in the ways that the underwriters want to see that risk shifted, so that they can look at us and say, hey, we are comfortable with how these governing documents are written. We're comfortable with how these associations have offset and mitigated their relative exposures. That again, we're going to carve out the limited capacity that we have, the good rates that we have, and place Association X and Association Y into those rates because they're taking these steps to proactively mitigate their risk, which in turn can be viewed as best in class. Similarly with clear financial management, active safety and compliance programs, when these insurance companies and these underwriters see engaged boards and professional managers that are proactively engaging with the risk management of their community, documenting steps to prevent losses, instituting a claims management procedure process, that creates a confidence amongst these underwriters to say, you know what, I feel that this risk, again, meets the standard of what will qualify as best in class, allowing us to release best rates. I've alluded to that a number of times, but the converse is also true. If none of this is happening, and if the board is kind of laissez-faire, hands off, fly by night, they kind of play these things as they come up, and we go out to market and we say, listen, the premium's gone up 10 to 15% every year for the past 3 years, which is not uncommon in the current marketplace. And I'm sure many associations have felt this. What is prompting these underwriters to look at this association, one of thousands that they receive from hundreds of different brokers, and differentiate them from the other associations? Why should they expend their limited capacity on you? Why are you a safe bet for them to give you the best in class, the rates? And again, what we found is that working in conjunction on one side with the association who's proactively managing itself, and on the other side with the underwriters, if we can present the association as best in class and we can take the necessary steps to engage in these best in class processes and procedures, we've found and we've had success in presenting those associations to the underwriters, selling the underwriters that they should, hey, this association has these processes in place, it has these procedures in place. This is one you should take a chance on. This is one where it makes sense to reduce the rate. This is one that you want to have on the books for a long time and strategically partner with. That's where we found success. And at the end of the day, that's really the crux of how you navigate an increasingly challenging market. You find what the people who are offering the premiums, which is the insurance companies, are looking for, and you take the steps necessary to meet their criteria to offset the increased rates. So not only are we doing this, we're, not only are we able to sell the insurance company on this and essentially convince them to take this step, we're also tangibly making improvements to the association on the ground that is actually mitigating risk. So, it's not like a smoke and mirrors game. What you're doing is taking fundamental, tangible, measurable, repeatable steps for things like preventative maintenance, financial management, loss procedure processes. So you are actively improving the association on a number of different fronts. And that improvement not only allows the association to run better, but it reduces the premium over time, not only on the front end, but again, over time, because what you're doing, you're keeping losses off the association's loss history. You are just making the association more palatable from an underwriting standpoint to any of the underwriters. Now, I hope there's a question. I was not that thorough or that clear, and I hit a number of different points. So this is a hobby horse of ours. We talk about this all the time. We're in this world. So, all right, Mark, there you go.
Yeah. So how do we see that in our connection with our property manager?
So how do you see what? I'm sorry.
Whether or not we're performing well.
So what you can do with your property, the insurance broker for your community can look at what the rates have been over time with your current insurance companies, and you can see how they've offset, either increased, decreased, what the deductible structure is, if you've implemented these procedures. I mean, it's all there, right? You just need to gather the information. And typically, the measurable, quantifiable nature of that can either be obtained directly through your property manager. Say, hey, what have been the premiums year over year? Why have they gone up? Have we marketed this? Who have we gone to? What steps have we taken to offset this? Have we looked at deductibles, either increasing the deductibles per unit water damage deductibles, et cetera? What steps have we taken How is this insurance company that we're with playing in the marketplace? Do you have a lot of, as you a property manager, what is your experience with insurance company X? Have you found them to be competitive? Have you found that the broker that's writing our policies is able to work with them? Do they have institutional expertise? Are they leveraging their relationships with the carriers? So all of that's there. I mean, you just got to ask for it.
Evan,
Is that down to the actual HOA association that you can see by each association? Who, what, where's the kind of performance list there?
I'm not sure I understand. What do you mean by performance list?
I'm not clear about why certain. I, I'm thinking if our association had had a very big claim recently, yeah, I could absolutely imagine that the rates might go up. Um, but I am struggling to understand if it's as much around good practice, but you haven't made a claim in the past couple of years. Is it also about where you are, the kind of association? Is it about yeah, yeah, I'm not really too
No, no,
sure how we could
you're
be better prepped.
it's a very good point. And it's something I should have touched on earlier, which is that the variables of each association, the acronym we use in the insurance industry is called COPE. It stands for construction, occupancy, protection, and exposure.
Okay.
What that means is it a non-combustible steel association? Is it wood frame? Is it sprinklered?
Yeah,
Is the sprinkler system NFPA 13, meaning
yeah.
extinguishing, or NFPA 13R, life safety? So all of those variables, are you in the inner city? Are you in the suburbs? Are you coastal? All of those things. You're 1,000% right. All of those things impact rating and do have a tangible impact on what these carriers do. Having said that, whatever the exposure is in the past few years, they're all rising, right? If you're a frame association, maybe you're rising faster than a non-combustible association, but the premiums are still going up across the board. And they're going up because of the reasons outlined earlier, which are just increased frequency and increased severity at the end of the day. And so to your point, you are a association that is frame construction or non-combustible, whatever it might be, the same goal applies. You still want to be and still want to institute these steps to A, tangibly improve the association's management, and B, tell a story to the underwriters to solicit yourself as best in class. Because even if frame associations are facing a 15% increase, whereas non-combustible associations are facing 8% average increases, right? You still want to be able to work those increases down over time. And what these processes and procedures do is allow you to do that. It allows you to kind of put the association on a sliding scale downwards. But what you're saying is 100% correct. Not all associations of the same geographies, of the same construction types, of the same year built, of the same sprinkler capacity, they're not all rising on a uniform rate. But I think what's important to remember is they all are rising. And so all of these steps, irrespective of the rate of increase, are still allowing you to offset that rate of increase, irrespective of what that rate is.
Thank you. Appreciate it.
Yeah, no
Hey,
problem.
Evan, I got a question. Based on the criteria that you have up on the screen now,
Mhm.
how does that get to either the underwriter carrier or carrier? Is that determined by them?
That's us. So when this gets instituted, when you engage in a preventative maintenance plan, when you have clear financial management, and when you document these steps, we as the broker make sure that these underwriters are well aware of that, right? That's our job, to make sure that the underwriters know what's happening, to make sure that they know why you took these steps, how you took these steps. So that the conveyance of that is the broker's responsibility. And
How do you know that though?
because we work with you directly and the property managers. We have that conversation if the association is in a position where we feel like none of this is taking place, that
Right.
we proactively go to the association's management or to the board, given whatever the relationship is, and make sure that those things are instituted. I mean, Russ, you and I speak all the time. If I felt that your association had a problem,
Yeah.
I'd most certainly let you know.
Yeah. Yeah, and I just want to make sure that we are, I know we do all these things, but in the way of the transmission of that information, that you're getting it, okay?
Yeah.
And I know you are to a great degree with us. Okay, all right, thank you.
Yeah, but that's it. You're exactly right. I mean, it's hard to cut through kind of the fog sometimes. But yes, if we engage in situations that are suboptimal, or we're brought in and we review the documents and the processes and the procedures of associations that are suboptimal. Prime example would be you're brought into an association who has a $2,500 deductible or a $5,000 deductible, and this association has seen a ton of water damage claims. Those water damage claims are maybe $12,000 claims, $17,000 claims, $27,000 claims. And that adverse loss history is putting the association in a position to be rated adversely by the underwriters because they have a frequency of claim issue. What is wrong with this what's wrong with this association? What's wrong with the building? Why is this inherently leaking? What's going on? And so if we come in there and we say, listen, all of these claims could be kept off the association's loss history by shifting responsibility more to the unit owners and increasing the deductible to something that is more industry standard of, a $25,000, let's say, or $50,000, depending on association size. Not only does that reduce the premium on the front end because typically higher deductibles correspond with a lower premium, but what it also does is it keeps those smaller, more ticky-tack claims off the association's loss history, allowing the loss history to be presented as cleaner and you to work that premium down over time. So that's kind of that proactive engagement and the proactive risk management that each of the association's individual brokers should be doing and reviewing and seeing, hey, this is what's our strategy here, right? You don't want to be passive and let the market, especially in a harder market with limited capacity, dictate to you. We want to be proactive and hash out a plan that we know works. And sometimes it's necessary. I mean, sometimes it's all hands on deck because an association has just had no proactive risk management, is constantly at the whims of the marketplace, and the unit owners are getting charged an arm and a leg. So once we can come in there, evaluate it, use the proprietary techniques that we've developed over time, along with our institutional expertise, and leverage with the carriers, given we're one of the largest writers of condominium associations nationally, it allows us to place the association from position A, not good, into position B, good and getting better. So it's really it goes back to that word I used earlier, which is proactive and proactivity. But that's how you want to engage it, and that is really the crux of the plan.
So this would be a punch list then that you would love to see somebody come to you with as far as insuring them, right?
In an ideal world, sure, but we also come
Yeah.
with the punch list ourselves. I mean,
Okay.
it can go both ways. That if let's say a property management Chemco takes over managing a property and they see it as in a poor state, they have this punch list. They can proactively engage this, as can we. It's just about taking that first step and evaluating critically, hey, what's going on here? What is happening to the association? Why is it happening? And how can we make it better? And a lot of times the passivity and the lack of proactivity is what leads to the association being in such a deep hole from a premium standpoint that it needs to crawl itself out of.
Okay, thank you.
Evan, what are some of the documented steps that we could take in regards to the association's governing documents?
Well, I'm very glad you asked that because that's where we're going next. I'll skip ahead one, but that's exactly where we're going with regards to the governing document. So a lot of times governing documents are old, they're ambiguous, they were written by attorneys that, might not specialize in the field, and they're not used as a resource or an arrow in the association's quiver to put themselves in a better position. So what you really want to do is align your governing documents with the best practices of the current insurance landscape. You can do that through amendments. You can do that through ratifications. You can work with your attorney. You can do that through board votes. There's a number of different mechanisms to do that. Something very simple, very easy we find is the second bullet point, which is deductible and assessment clauses. We might see older deductibles where the association's governing documents don't require, cap the deductible that can be possible at $10,000 because in 1977, when those decks and bylaws were written, that was an astronomical figure, and they didn't want to put increased onus or responsibility on the unit owners. That's changed, right? That's no longer the world that we're living in. So reviewing those governing documents, using them as a tool, and essentially aligning them with best practices is how you want to leverage the governing documents to the underwriting standpoint. You want to remove any ambiguity and clearly and specifically clarify what the responsibilities are between the association and the unit owners, so that in the event of a claim, everything's crystal clear. You want to codify and require the necessary preventative maintenance that we were talking about. I mean, those are things that you say, hey, if you need to, get your washer, get the washer lines braided, or replace the plumbing, or replace the roof, or do any of those things, who knows what success rate you ultimately have. But if you codify those things within the governing documents, and can use the governing documents not only as a tool, but as a cudgel against maybe some unit owners that might not be receptive, you take those governing documents that might have been ambiguous or just existed or just been something and you use them as a tool in your favor. Again, I keep going back to the buzzword that I've been talking about this whole time, but you have to do that proactively. That requires proactive engagement with the documents to see, hey, what's actually in here? What are we doing? Are these documents working to our advantage, or are they hindering us from an insurance standpoint? Because a lot of times at this point, given the age of an association, Mark, to your point earlier, given the age of an association or its construction type or its sprinkler percentage or what have you, it might act as a hindrance in the current marketplace. So reviewing those documents critically, knowing what the insurance companies are looking for, knowing what's best practice, you can augment and change those documents so that they work to your advantage, as opposed to being kind of an anvil around your neck from a rating standpoint. All right. I skipped ahead a bit. Oh, sorry, Mark.
Insurance carriers share good or and bad associations with each other.
Like the scuttlebutt behind the scenes?
A little bit, yeah.
The short answer is kind of. I think underwriters are friends. They hang out, they get drinks together, they tell war stories. Similarly, in any business, right? So I think what's most important is that if you're an association and every single year you're shopping your coverage, you're going out to different brokers, and you've gone to this insurance company 10 years in a row, and they've seen your risk 10 years in a row, and they haven't written it 10 years in a row, they're going to look at this and say, what the hell are we doing here? These guys are sending it to us again. We're not going to offer the coverage. We don't want anything to do with this. I think that, that kind of segues into something else that's not really in the presentation, but that's important to recognize, which is that when you think about these insurance companies, and when you think about the association's relationship to insurance writ large, it shouldn't be from the process of a transaction, right? What you don't want to be to these insurance companies is transactional. You don't want to treat them as just another widget that you go in, hey, are you offering me the best premium? No, I'm going somewhere else. Okay, they're not offering me the best, I'm going somewhere else. You want to try to align with these insurance companies, assuming that they're the best company for you, as a strategic long-term partner. That collectivity, that working together where you're all rowing in the same direction, where the insurance, you might have a down year, you might have a good year, but the insurance company overall over the past 3 or 4 years, you have a great loss ratio. They're able to offer rates, they're able to make favors, they're able to kind of stick with you together. That's really what you want to do. You want to place the coverage with the carrier that's appropriate, whether it's an AM best rated A+ carrier for some of the larger ones, or a surplus lines carrier, unfortunately, for some other, maybe coastal associations. But you want to find the best home for the risk and then leverage the hell out of it, where you create incentives on both ends to stay together and work that premium down over time. If you just flip around transactionally and jump around and go around, to your point earlier, people are going to find out. And these underwriters are people just like you and I. If you spin their wheels more than a few times, they're not going to go out on a limb for you. So to your point, are they saying, hey, Summit Ridge, sorry, Russ, I'm still looking at you. Is Summit Ridge this terrible association and everyone knows it and we're going to stay away? Not necessarily. But if these underwriters have been at the same company and they see the same risk and they see the same submission and they never get it, they're not going to give you the best they have to offer. You're not going to get those best in class rates at a limited capacity.
But then as they see Summit Ridge as a great HOA, right?
They sure
Carry it
do.
through.
They sure do, Russ. GNY loves you. We're in a good position.
I've
Thanks.
heard it's a great place too. Yeah.
Yeah.
Most of our insurance claims have been water damage,
Yeah.
and most of the time it's the negligence of the homeowner. Is
Mhm.
there anything that we can do or put into our documents that would limit our liability?
Not necessarily, because associations can't subrogate against unit owners, unfortunately. You could put in certain, we're kind of zooming out and getting into a context of moral versus morale hazards, right? If a unit owner just leaves their window open and rain gets in and it causes damage, it's hard to penalize them for that concept. But if the water is coming from roofs or drain spouts or other types of situations that they haven't updated, right? Where you have certain requirements within your governing documents that mandate proactive maintenance, preventative maintenance, replacements, whatever it might be, and they haven't done that, and that lack of compliance with the governing documents subsequently leads to that damage, then you could, if they're out of compliance willfully, then you could assess them for that. But that's really the only way you could do it. The association isn't responsible for subrogating, or is legally barred from subrogating back against unit owners.
Give you an example is that this winter, one of our homeowners left her garage door open quite a lot. And of course, it was an extra cold winter. And she has a wash tub in her garage, and of course, the water froze.
Yeah. I don't think you could penalize her. It's, unless there's something in the documents that say you can't leave your garage door open or something, to that extent, it just seems like a moral hazard where you can't insure stupid.
There is we do have rules that say your garage door must be closed at all times unless you're using it for something, but just to leave it open, you can't do that. And she
Well,
did.
I'm happy to review those documents and kind of drill in more specifically if you want to send them to me, but it's hard to say without really reading it and seeing exactly what's there.
Okay, thanks.
Can I just chime in that we've been successful with some communities where we've done hot water heater replacement resolutions or washer hose replacements, and sort of doing a proactive resolution in that sense to where we're requiring certain receipts or replacement information after a certain period of time that hopefully prevents the situation from happening. It still doesn't give us the recourse to be able to subrogate back if the incident occurs, but at least it gives us that level of proactivity to have those items replaced ahead of time.
Mark, got your hand up?
Yeah, it's me again. So I know this sounds obvious, but can you just explain the difference between non-combustible associations and frame? I think I know what it is, but I'd like to hear it from you.
Frame is wood stick, so it's it's wood construction, wood stick construction. Non-combustible could either be steel, cinder block, fire-resistant materials, anything along those lines.
Do you feel that that has an impact on the age of the association, or is it just the fact between the materials? Are associations still building as frame associations, or has there been a change in building?
It's a really good question, and it's more of like a 30,000-foot view onto the construction industry. But unfortunately, many associations or many builders are choosing to still build using frame construction. I mean, the most popular building style right now, let's say in downtown Philadelphia, where I know you guys are, most of you aren't, but it's called podium style construction. I'm sure you've seen it, where the first floor is structural steel, and then they put frame, either 3, 4, 5 stories of frame construction above it. And a lot of times, the developers and the builders choose to develop this way because it's the most cost effective, right? It's the fastest, and it allows them to get the buildings up quicker at a cheaper price. Along with that, the sprinkler system in frame buildings is a huge component. to be compliant with guidelines, you need to build, the minimum sprinkler requirements are NFPA 13R. As I kind of alluded to earlier in the presentation, that means it's life safety. So it provides enough sprinkler, in theory, for the residents of the building to get out safely, which is fantastic. It's not necessarily preserving the building. Sprinkler systems that have the capacity to preserve the building are NFPA 13. They're significantly more expensive, so builders mostly just choose to put in, NFPA 13R. That has a large impact on rating for obvious reasons, right? If you are a non-combustible building with a self-extinguishing sprinkler system, that is rated on a much more positive basis than if you are a $30 million frame building that has just life safety sprinkler systems. So to your point, it's apples and oranges. I don't know if it's necessarily apples and oranges, but it's difficult to say. Most of the time, the builders are building this way because it's cheapest and fastest, not necessarily because it ultimately has the best downline impact on insurance costs for the end users, right? Because if a Lennar or a large home builder, Post Brothers, build a home and they sell it, or it converts into a condo association, most of the times, they're out and they're not worried about the insurance costs. So I wish I had a better answer, but that's kind of the broad strokes of it.
I appreciate that. Again, thank you.
Yeah, no problem. Sorry, I kind of accidentally hit the back button. Anything else? Yeah, we kind of touched on this earlier. Maintenance, safety, and compliance. Julia alluded to it. Proactive replacement of the water heaters, proactive replacement of the washing machines, making sure we're exercising the toilets, that the heat pumps and the HVAC are up to date. There are very specific items within units, within homes that cause claims frequently, and that cause claims with severity. So I'm more than happy to distribute this checklist, but there are certain things that we really want to, if we're looking to proactively make changes and proactively require active maintenance, there's certain items that we really want to target, these being the primary ones, A, because it's beneficial, and B, because we know it'll resonate with the insurance companies. Governing document slide. And lastly, before I wrap up and kind of open it to questions, there are underwriting levers that you can pull, and this kind of it ties in everything together, right? You want to try to take from a philosophical standpoint, we believe in higher deductibles. I think higher deductibles do a number of different things and really reinforce the concept of a best-in-class risk. It demonstrates to these underwriters that this association is taking its risk management seriously and is assuming more of the risk, because that's what a deductible is. It's the association or the insured's assumption of the risk. So if we can show them that we are comfortable assuming more of that risk because we're taking these proactive steps, it allows us to present a really compelling narrative to the underwriters. Additionally, it keeps, as I said earlier, these smaller claims off the association's loss history. It allows you to get the best premium on the front end while saving the association dollars in the long term by keeping the association's loss ratio as squeaky clean as possible. And the only claims that are on there would be severe claims. And quite honestly, underwriters can get their head around severity, right? Severe claims happen. That's why you have insurance. It's the frequency issues that give most underwriters headaches from an underwriting standpoint. So higher deductibles, proactive capital improvements, CapEx projects go quite a long way, as does claims management. If you're an association that is just kind of letting the claims team or the adjusters kind of do what they want, you don't know, and you're not proactively reviewing your loss runs and your loss history, you're really putting yourself at a disadvantage, because these adjusters might have a $200,000 reserve sitting out there that God knows if it's ever going to get there, what it will ultimately settle for. But that $200,000 reserve for maybe a small slip and fall claim is still on your loss runs and still on the association's loss history, which is negatively impacting it from an underwriting standpoint. So if you're able to proactively review these claims, proactively address them, see what's going on, ask the insurance company, say, you have $200,000 reserved here. Do we really think that's necessary? What is going on here? Can we take that down? Can we take that 200,000 to 20,000? Can we remove it entirely? Why is it still on there if the claim is, hasn't gone anywhere? You can proactively manage the way that these adjusters are kind of reserving dollars, which impact your loss runs, to allow us, again, to tell a more compelling story to the underwriters. So the key takeaways, again, the market challenges are navigable with preparation, with proactive preparation. A lot of that is relative to the maintenance and governance, which tangibly improve results. The way that you do it, proactively engage with you early with your insurance broker. Your insurance broker will be able to help you walk through these challenges using data and transparency to your advantage. So I will stop talking. I've droned on a little bit too long, and open up the floor if anyone has any questions.
Hey, Evan, may I make a comment?
Sure.
Would you mind going back 2 slides to the pulling the lever slide, which I think is great. First of all, great job. One area that I think a new lever that I've started to see is with risk transfer. More and more insurance carriers are requiring and looking for copies of the contracts with, let's say, snow and ice removal contractors, and making sure that they're indemnifying the association and the manager, that that their insurance is responsible, has certain limits of liability. And I think, that's critical today in becoming best in class, because a lot of these slip and fall claims and or claims from contractors that may cause water damage, et cetera, if there is proper risk transfer, making sure that you have certificates of insurance with the appropriate limits, naming the association with the right limits of liability, their coverage being primary and non-contributory. I think the carriers are really seeing that as something that adds a lot of value, and something that maybe is another lever that you can pull.
100%. You're absolutely right. Yeah, I'll update the presentation. You're 100% correct.
So, and I know that Camco does a pretty good job of making sure of that, but I just wanted to bring it up to everybody's attention that we're seeing that more and more with insurance companies. In the old days, it was, hey, if you have it, great, provide it to us. Now it's part of the underwriting process.
Yeah, specifically with snow removal. I mean, you hit on it. And GNY, who's a big insurance company, has become huge sticklers about making sure that the verbiage within the contracts between the association and the snow removal company is proper, from a risk transfer, hold harmless, indemnification, that all that verbiage within the contract is in the association's favor. So again, yeah, absolutely right. And something we should certainly keep in mind for anyone who's part of the board or association.
Hey, it's me again. I wanted to ask, a lot of our residents are very aware that they're in a HOA, because there's lots of things they don't want to do, like the gardening and the weed work, and they have a great advantage of being in a HOA because it kind of spreads the cost. Do you have any number that almost explains what's happening to the insurance market if I was a single family home owner out in the suburbs? If you see what is the same thing happening to their insurance issues?
So it depends, because it depends what the guidelines of an individual association says, right? What the unit owner versus association is responsible for insuring, relative to someone who owns a single family home who's responsible for insuring, their entire home. So it offsets in a bunch of different ways, and it's really dependent on the nature of the individual governing documents.
And I just wanted to add that I know some of our board members on here also are part of associations where there is not the master property coverage. So it's simply just, liability and the other policies. So I think, to Ken's point, a lot of what we are seeing is claims related to liability, slip and falls, et cetera. And some of those losses can be more than some of our property claims sometimes, depending on the situation and what's happened. And so we are seeing an uptick in some of those claims as well. So having, which I know you guys do, having those sort of same checklists that you have for the property coverage, in terms of, what we can do liability wise for, contracts like Ken mentioned, reviewing walkways to see if there's tripping hazards there that are part of the association, etc. So I think that that's helpful, and stuff that we can also work with our insurance brokers on, especially if we do have a larger loss history for liability too.
Yeah. And yeah, I think a helpful way to think of it is these property claims are finite, where you insure a building for a certain amount, and in a claim, if the building goes poof, you get that amount back. These liability claims are infinite in theory, right? Anyone can sue you for anything, for any amount. A judge, jury might award any kind of amount to you. So we touched on it a little bit earlier, but you're exactly right, Julia. They're increasing with frequency, and ultimately the severity of the claims are crazy, especially in more favorable jurisdictions.
I can also just quickly speak to having a single family home insurance policy, and mine doubled. Personally, I'm not a part of an association, but yeah, mine doubled as well over the past couple of years. And, there are certain ways that you can work around it and check with different carriers, but a lot of people are affected by the market as a whole.
Yeah.
Yeah.
Reserve study, Evan, real quick. I think it's important, but conforming to the reserve study and what's recommended by the engineering firms that do that, where that plays into all this.
Similarly to all the other variables. Yeah, it's just another arrow in your quiver to present to these.
Right.
Exactly.
We have a very low loss ratio, and our insurance has gone up very, very much in the last few years. Is what's going on here? What is a typical loss ratio in the business, and is it just because we are in a bad pool?
It's hard to say definitively, right? Without knowing anything about your specific association. But yes, rates are certainly going up. They've mitigated it to a certain extent. What the average loss ratio is completely dependent on the association or the risk itself, right? Some associations have 10 years with 2 claims, some have 10 claims in 2 years. So, it really depends on the nature of the association itself. It's hard to average that out. But again, Dave, if you want to send me specifically,
I'm asking about the industry standard, not the individual association.
What you mean, like what an average loss ratio is for a residential association within the larger insurance industry?
What is the loss ratio that the insurance companies finds acceptable and targets?
Understood. That's a good question. I mean, typically they like to see under a 50% loss ratio. They have operating costs. These insurance companies have, expenses that they need as well. So it's not just pure profit for them when they take in more money than they pay out in claims. So I think using a 50% loss ratio, maybe lower, 40% is favorable. But that's a very good question, and it's hard to say definitively, but I think that's probably a pretty good benchmark to use. I don't know, Ken, you might know better than me with regards to that.
You nailed it. I mean, at a 40 to 50% loss ratio with all the expenses, that gets an insurance carrier with a combined loss ratio up and around the mid to high 90 percentile, so 95 to 97% combined loss ratio. So making about a 3% underwriting profit. And then they have to factor in what interest rates are at that point. So if interest rates are really low, like they were years ago, then they're making a 3% profit, which isn't a lot. So you might see insurance rates rise because the combined loss ratio is too high. There are other years where their combined loss ratio is 100%, but their interest rates, they're making 5-6%. And if they're a large company like a Travelers, 5-6% on 30-40 billion is a pretty nice profit. So they may be okay with a 98 to 99% combined loss ratio. But to get there, look, they've got agents' commissions, they've got this, they've got claim expenses, all the various things. And I would say to kind of break even on an individual account, max 50 to 55%. To make an underwriting profit, they really have to be under 50%.
Now, I'm pretty sure that in the healthcare business, the loss ratios run typically 80 to 85%. Why is it so much higher or so much lower for these companies to make a profit?
Well, it's not 50%. You have to add on, that's your pure loss ratio. The combined loss ratio, when you look at what your losses are, plus their expenses, i.e. the cost of their employees, the cost of commission to insurance brokers, the cost to handle claims, all of that, those are expenses added onto your pure loss ratio in property and casualty insurance. And so that's averaging by insurance company anywhere from 40 to 45% of the dollar that comes in that they have in expenses, in addition to your pure loss ratio. I mean, companies like you see, like Geico, et cetera, all these, their loss ratios on personal insurance is well over 100% combined. So that's why it's important to minimize the losses. If you can be one of those associations with a 20% historic loss ratio, and they look back about 5 years, typically, what your loss ratio is. So they're not looking back just the last couple of years. They're looking back, they want to see a 5-year, sometimes now 6-year history of what you have done. And they'd rather see an association whose loss history has improved over time rather than one that's going in the opposite direction. So if 5, 6 years ago you had losses of significance, even over 100%, and they see a nice steady trend, positive trend downward in frequency and severity, that's also going to be an advantage for you when you go to the marketplace.
I think we have time for one more question.
Yeah.
Anybody?
Yeah. Can you hear me?
I can hear you, Tim.
Oh, great. I was wondering, how often should property go to the marketplace to review their rates and check for the possibility of improving their situation?
It's a really good question, and something that should be done in consultation with your broker, right? If depending on the unique variables or the factors of your association, again, whether the construction type, the loss history, the year built, whatever the COPE information is, what your claims might be, what is going on in the larger marketplace, depending who your current carrier is. There's no right answer to that, right? It's not like you should go out every 3 years or every 6 years or something along those lines. So I think if you proactively look at what the context of your individual association is, you engage in that with your broker to see, hey, what makes sense here? What are you seeing in the larger marketplace? How does our association fit in? What's going on with our insurance company, the carrier that we're with? Why are they raising rates more than others? Are you seeing other associations, or excuse me, other insurance companies that might be offsetting rates for similar associations less than our current company? So it really should be done in consultation with your broker. And there's no real benchmarking answer because, you know, if you have a good situation, you might want to, as I said earlier, kind of look to strategically partner with that company and work down those rates over time as opposed to transactionally going out to the market. So it really depends on the unique nature of your association itself and who you're with. So it's hard to say definitively, if that makes sense.
Right, to see if you can build a relationship with your existing
Totally.
partner, and sometimes can be very beneficial. One other specific question, if I may, very quickly.
Sure.
If you have a claim against the property and it goes through the processes, the insurance company employs their attorneys on behalf of the property, and the property wins, does that still have a negative effect against the property's assessment or rating?
Depends if the property is able to subrogate back against the claimant, which they win, right? So hypothetically, if there's a claim where the association ultimately pays out $100,000 to settle the claim, but the lawyers behind the scenes or the association's attorney or the carrier's attorneys are able to subrogate against someone who might have caused that claim, that $100,000 could go down to 10 or 5 or 20 or whatever it might be, which then takes that loss from $100,000 to a $10,000 loss, right?
Yeah, a little bit more specifically, you win, there's zero payout by the property. Would that still have a negative impact? In other words, you had a claim, and do they just look at that, or do they look at the outcome of the claim?
Evan, may I take this one since it happens to me all the time? So unfortunately, it does have a negative impact. So let's say it's a director's and officer's liability claim, and even though it's just an alleged matter and it takes a couple years and there's 60, 70, 80,000 in defense costs, it's dismissed. It still affects the way an insurance carrier looks at you and underwrites you. So I'm not trying to discourage anyone from turning a claim in because they're afraid it might increase, but we do have to keep an eye, kind of what Evan said earlier in the call. Your broker should be looking at your loss history, pulling loss runs on a quarterly basis. There's an increase in reserves, getting the board and management involved in making sure that the monies are spent well and that the reserves are not crazy and things are being resolved as quickly as possible. Because yes, it can have an impact even if it's dismissed and you're found, quote unquote, not guilty.
Right. Thank you.
I want to thank Evan and Ken for your time and the informative presentation you guys gave us. It was definitely great to hear from you guys. You guys are one of the best in the business. So we definitely appreciate your time, and thank all the board members for joining us. Our next board roundtable is going to be reserve studies and capital project planning. So they set you right up to get you on the way to make sure your association's set. And that will be on June 11th at 6 p.m. Thank you guys for joining.
See you guys. Thanks so much for the time.